So I would suspect that there's a lot of room left. JP Morgan Chase doesn't have statistics going back to 1981, but they suggest by dead reckoning that the market share of precious metals relative to other asset classes in 1981 was between 6 and 9%. They also say that they believe that the median market share of precious metals relative to other asset classes over the last 40 years, not all of which have been good for gold, is 2%. So, if the market share would revert to mean, which is what I think is going to happen, demand for precious metals and precious metals related securities increases 3 to 4-fold, which tells you something about the magnitude of the market that I think is in front of us. Silver begins to outpace gold. And I think we've seen that this year, but we've seen it dramatically in the last 3 months. So that does suggest the beginnings of generalist participation in the gold space. It was estimated by JP Morgan Chase 2 years ago that the market share of precious metals relative to all asset classes in investment and savings markets in the United States meant that the market share of precious metals was less than 0.5%, which is to say 0.5% of the asset value of all savings and investment classes in the United States was invested in precious metals. That number is now ostensibly up to something like 0.75. Okay. It isn't even 1%.
Rick Rule says the precious metals bull market is just starting. Silver rising faster than gold shows new investors are entering. Gold and silver make up less than 1% of investments, so even a small shift could push prices much higher. He warns there will be big price drops along the way, but long-term gains can still be huge. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
Despite the fact that I believe in higher, probably sharply higher, nominal gold prices over 10 years, we will absolutely, positively, without a doubt, experience a 25 or 30% price decline at some point in time. I would urge people to study history. In the 1970s bull market, the price of gold went from $35 to $850, an epic run. And in the middle of that, in 1975, the gold price fell by half and the gold equities fell by more. So speculators need to steel themselves temperamentally and financially for volatility. It's interesting to note that 50% decline in the gold price didn't derail the gold bull market. The people who got shaken out by it missed a move from $100 an ounce to $850 an ounce, an 8-fold move in 6 years. It's a test of character. But that's coming. Make no mistake. We are in the midst of a precious metals bull market that will be one for the ages. One that will be reminiscent of the 70s when I came in the business. One that will take the top off of our imagination because we've been beaten so thoroughly since. I think, we're 2 years out from a raging commodities bull market too. I think we have to deal in the interim with maybe softer commodity prices that are a consequence of declining global economic growth, the very soft oil quote, and the relatively soft copper quote relative to production shortfalls tells me that we're having trouble selling material. But I think that problem begins to alleviate itself. And I also think that supply shortfalls will be greater than potential demand shortfalls. So I think we're going to have 2 bull markets. The biggest opportunity, risk relative to reward, that I see in the resource space is still the oil and gas business. For all the reasons that I talked the last time that you and I visited. But if you're a believer that today's gold price holds, and I am, I mean, yes, we will have periodic declines and they'll be ugly. But if you believe that the long-term trend of gold is steady or up, which I believe, the gold stocks are not expensive. They are certainly priced higher now than they were 18 months ago. But the net present value of those companies' free cash flows at $4,200 gold is way, way, way higher than it was at $2,500 gold.
Yeah.
I did net present value calculations on Agnico Eagle in my last 3 conferences where they've been an exhibitor. And the stock is, by my metric, which is to say the net present value of free cash flows, cheaper after the stock has doubled than it was before it doubled as a consequence of the fact that net present values are higher. And the investment that we've seen in the mining side, I think has been misinterpreted.
Okay.
In the first instance, there's a lot of malinvestment. There have been a lot of juniors who haven't been trying to explore. They've tried to twin a previously successful hole so that they can raise the next financing so they can salary it. That's not the same as exploration. So we have been guilty both of underinvestment and of malinvestment for a very long time. I would argue in the copper space, we have underinvested for 30 years. And that isn't a deficit that you're going to be able to make up in 5 years. There's absolutely no curing it. We're going to have price discovery, not like the copper price discovery that we're having right now.
Right.
And the same thing in oil and gas. The oil and gas valuations aren't as dramatic as they were during COVID. You know, when the oil price briefly went negative, settled out around $20 a barrel. But we're going to have price discovery. You try to find people who have been successful in the past at mining, but particularly people who've been successful at the task at hand. So if the task at hand is exploring in British Columbia, does the team have experience in accreted terrain, in epithermal gold or copper gold porphyries, preferably in BC? Which is to say, if their experience is operating a producing mine in French-speaking Quebec, but the task at hand is exploring rather than producing in younger terrains in Western Canada, the experience, while real, isn't particularly valid. So you start with the people and the task at hand. The second question that I think you have to ask after you've gotten through the people, because people let you know if you care about the answers to the other questions you ask them. You know, are they worth talking to? The next question is, tell me what the most important unanswered question is. With junior companies, as the knowledge around the company's asset base increases, the value of that asset base increases and the share price can increase. So ask them what the most important unanswered question is that they're going to ask. And the related questions, how long will it take to find out, and how much money will it take to find it out, and do you have that money? Probably 80% of the time, Jay, that I've asked that question about unanswered questions in the last 40 years, the management team has said to me, I never thought about it in that context, which is to say they don't have a plan. To them, the most important unanswered question is, will I still be drawing a salary in 18 months? And while I can understand their interest in that question, it's of no interest to me whatsoever. And then the third thing I would ask, so that you can ascertain your downside, is if you broke up the company today and sold the assets in your company to third parties, what would it liquidate for? I'm not trying to say that you have to buy dimes on the dollar, but if the company has a $50 million market cap and the liquidation of their assets to willing buyers, knowledgeable buyers, is $1 million, you need to understand that your potential downside is 98%. And you need to take the upside in the context of the downside. So if I had to limit it to 3 questions, it would be, who are you and why should I care what you have to say? How are you going to add value for me in the next 12 to 18 months, which is to say the unanswered question. And what's my downside look like? The largest copper mine in the United States, producing copper mine, is one called Bingham Canyon. It's produced for 100 years. It is the largest copper mine in the U.S. When you fly into Salt Lake, you can see it. It looks like a moon crater. We need to put in production a new Bingham Canyon every year. The problem is we don't have any right now. We got to go find them and develop them. One example around copper is Resolution, a very, very, very high quality copper project in the United States, allegedly a tier 1 location in Arizona between two copper mines. Highway goes across the property, rail goes across the property, power goes, water, next to a town full of copper miners. Couldn't be any better. Great deposit, over 1 billion tons of 1.5% copper, 3 times the average grade worldwide. The thing's been stuck in permitting for 28 years. Permitting is a problem. Underinvestment for 30 years is a problem. Now that the copper price is up, greedy governments around the world are doing what greedy governments do. There's 2 years of consensus production deficit in the copper business, which is to say we're using more copper than we're producing. In the face of that, 7% of world copper supply came offline in 2025. Grasberg, Kakula, Cobre Panama, the Codelco difficulties. If you have a market that's in supply deficit and 7% of supply comes offline, the rebalance of supply and demand would suggest a 25 or 30% increase in the price of copper. Instead, we had 6%. That tells me that demand is much weaker than people anticipated it being. Otherwise, that that deficit would have found a different price equilibrium in the market to balance supply and demand. The same thing on the oil side. People talk about the oil glut. While the biggest swing producer in oil, which is to say the United States, has crested in terms of shale production and headed down. $55 oil doesn't work for a lot of producers. The International Energy Agency says that the incentive price, the price at which global oil and gas companies earn their cost of capital, is $60 plus. So you make the stuff for 60 plus, you sell it for 55, you do it 102 million times a day, which is to say you lose $5 a barrel. 102 million times a day, it gets pretty ugly. And that's borne out by the sustaining capital investments of the oil and gas industry. Depending on who you listen to, the industry on a global basis, including the state-controlled firms, is underinvesting in sustaining capital to the extent of somewhere between $1 billion and $2 billion a day. While that may or may not impact the company's abilities to produce in 2026 or even 2027, it begins to bite 2 or 3 years out. It's a capital-intensive business. If you don't add capital, someday you have no business. Venezuela's in the news. For the last 22 years, they've deferred sustaining capital investments, and their daily production has fallen from 3,300 barrels to 800,000. 3.3 million barrels, a day, to 800,000 barrels a day. They've had 80% production declines. That's what happens when you defer sustaining capital investments and you eliminate new project investments. And that's happening around the world. People will use aluminum wire as an example. They'll substitute aluminum for copper. They will take less competent material for a lower price. But that's over time. Right now, the substitution makes no sense because copper is so efficient. And of course, rising energy prices will increase the finished price of aluminum too.